Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. Paris rapeseed. Prices extended their break higher, made 5 weeks ago, up and out of the early July to late October 2022 bearish Andrews pitchfork, which has its tines highlighted on my daily chart in purple. Initially, the market seemed unhappy about letting go of the broken upper tine, and I suspect that may have had a lot to do with the coincidence with a congestion band between 438 to 445 and 3/4 and the then flatlining short medium moving average, currently at 441 and 3/4. Such that for a while the market used the broken upper tine as an attractor. It was only when the upper tine finally dipped below the congestions that prices tried higher. However, even then the market ran into another, less powerful congestion area overhead between 460.5 and 468 and 3/4, which contains the 2013 high at 464.25, the June 2021 low at 468 and 3/4, and at the time the shallowly declining medium moving average, currently 454.5. Yet after some hesitation, last week the market broke up through this congestion and consolidated that move higher with a gapping action this week. Prices then had a fairly easy run up, filling a gap from March on the way through the congestion at 491 and 3/4, 497.5 and 504.5. It was only today that we saw the market really hit some serious congestion, made up from the congestion band dating from September 2012 of all things, between 513 and 3/4 and 519.5, but which was reinforced this time by the declining long moving average, currently 519 and 3/4. 3 weeks ago I commented on the market thus, and I quote, "So, what else does the recent actions show? Well, we could look at it all as a possible descending scallop pattern build here. But, and here's a big but, it will depend on what the market does should it get down as far as the May low at 386 and 3/4, and there's a lot in the way in the meantime. Before I sign off, I don't want you to forget the other larger pattern here, one that is so large that it has disappeared off my daily chart, but is still there. It is the February 2021 to July 2022 ascending broadening wedge pattern. To be honest, it is a large but imperfect pattern. Yet it had been the main market driver higher in the early part of 2022. The break lower in July last year left the following incredible targets on the downside, which I highlighted back at that time and obviously ever since. The primary target X is in the 352 even area, which you can see on my daily chart, and a harder to reach target X1 in the 217 area. These were at the time, well, pretty much way out there targets that you could put into your diary on the back page and just look at maybe once or twice a year. And that's the end of the quote. There's a lot to take in with those comments. For the moment, I will set aside the big February 2021 to July 2022 ascending broadening wedge pattern and instead concentrate on the idea that this market may have formed a late October 2022 to date descending scallop pattern. So in this pattern, what we are looking for is where the market will halt in its ascent, so that we can have an idea of the subsequent size of the move. Then we need to ascertain whether this move is a further move higher or a pullback lower, so that we can apply the size of the move to the actual move. At the moment it's a little too early to see if today's bearish pattern is the top of this run up. But I will say this, halting at where the long moving average crosses the significant congestion area is a reasonable place to pay close attention to. I will add this final comment. Data collected indicates that markets break lower something like 8 out of 10 times for this pattern. Winnipeg canola. A drop over May down through the 2021 low at 629.5 back 7 weeks ago, saw a subsequent recovery back up through the June 2021 low at 655.90, over the combination of the then declining short medium moving average, currently 713.20, and the old July 2008 high at 710.80, which was the gateway to congestion seen throughout March, April and May, and stretching up to the July 2021 low at 761.90. It had within it the then declining and now flatlining medium moving average, currently at 730 even. It is within this congestion, just under the declining medium moving average at the time, that the rally subsided, spending a couple of weeks in between the short medium moving average below and the medium moving average above. The action over the middle of May to middle of June created a V bottom, but I raised a question last time as to whether the V bottom would have an extension or a handle, and or whether it would even then morph into a descending scallop pattern as well. Well, the answer to the first part was yes. We had an extension stroke handle, a pretty clear one that turned out to be also a bull flag. This prompted the move up 2 weeks ago, and prices punched up through the July 2021 low, the March 2008 high at 770, the previous all-time high, and in the middle of last week through the significant flatlining long moving average, currently at 789.5. This last one was significant, as just above the long moving average in the 808.5 area was the target for the bull flag that formed that actual handle. Since then, prices have pushed higher still, through the congestion at 808.60, the August 2021 low at 817 even, the significant 50% Fibonacci line of the May 2019 to April 2022 move at 820.60, and the September 2021 low at 839.20. Above, we still have the congestion from December 2022 and January this year that stretches up to the 880 even area, and the subsequent 50% Fibonacci line of the October 2020 to April 2022 move at 863.80. However, it's worth looking at what has already been achieved. I've mentioned the bull flag market, the bull flag target, but I would like to now address the idea mentioned earlier of a descending scallop pattern here. This pattern was not a pretty pattern, but it had seemingly managed to work, a little at least. However, the descending scallop pattern here has been overshadowed by two other patterns which have shown a much stronger bullish incentive: the V bottom with a handle and the bull flag. Thus, I will retire this idea and now consider if the market, after this commentary of course, and now consider the market has enough energy to try up to the really big overhead resistance, and that's the 50% Fibonacci line of the big August 2022 to June 23 move at 912.5. Ursa Malaysia crude palm oil. The mid-August to early November 2022 mildly bearish shift pitchfork is still running the show here after so many months. This is highlighted in dark green on my daily chart. This mildly bearish pitchfork has guided prices more or less lower, initially in between the upper time, currently at 41.63, and the middle time, currently at 35.30. Then for a while in May and June, between the middle time and the lower time currently is at 29.98, before moving back up again in between the middle and upper times. The more recent developments have seen prices push up and stabilize over the slowly declining medium moving average, currently 38.05, and especially over the ever so slowly rising long moving average, currently at 38.69. This stabilization has been very interesting, as the market has seemingly not only formed a recent hesitation area over July, but that hesitation area is in fact a double bottom with an as yet unreached target X for this pattern in the 41.20 area, just under the upper time. The small gapping action over last weekend helped that move higher to happen. Question now is whether the market will follow this pattern idea higher or stumble. So the next obstacle, well, the market has already encountered the next obstacle, and that's the extension of the neckline for the old but potentially still influential 50% Fibonacci line, the September 2015 to November 2017 move, currently at 40.40. The reaction upon reaching it has been, frankly, underwhelming to the bulls out there, but it is still early. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.